Welcome to our in-depth tutorial on hedging. Today, we'll demystify the concept of hedging, explore its types, and understand how it can protect your investments. Let's get started. To begin with, what exactly is hedging? In simple terms, hedging is a risk management strategy used to offset potential losses in investments by taking an opposite position in a related asset. For example, imagine you own stocks in a technology company. To protect against a potential drop in the stock price, you might purchase put options. This creates a hedge against the stock's downside risk. Hedging is akin to purchasing insurance. Just like you might buy insurance for your car or home to protect against unforeseen events, investors hedge their investments to protect against market volatility. Let's now understand the different types of hedging strategies. There are several types of hedging strategies, including futures, options, and swaps. Each of these instruments serves different purposes and is used according to specific scenarios. Let's dive into each one. First up, futures contracts. Futures are standardized contracts to buy or sell an asset at a predetermined price at a specific time in the future. They are commonly used in commodities markets. For example, if you're a farmer expecting to harvest 1,000 bushels of wheat in 6 months, you might sell wheat futures contracts to lock in a price now, hedging against the possibility of wheat prices falling. Next, we have options. Options give investors the right, but not the obligation, to buy or sell an asset at a predetermined price before a specific expiration date. A common use of options is to purchase put options to hedge against a decline in stock prices. For example, if you own 100 shares of company XYZ, you might buy put options to sell those shares at a specific price, thus protecting against a potential price drop. Lastly, let's discuss swaps. Swaps are derivative contracts through which two parties exchange financial instruments, usually to manage exposure to fluctuations in interest rates or currencies. For instance, a company paying variable interest rates might enter a swap agreement to exchange its variable rate payments for fixed rate payments, hedging against interest rate volatility. Let's illustrate these concepts with a real-world example. Suppose you're an investor with a diversified portfolio including stocks, bonds, and commodities. You anticipate a market downturn but don't want to liquidate your assets. One approach could be to purchase index put options to hedge against the overall market decline. This way, if the market falls, the gains from your put options can offset the losses in your portfolio. Now, let's consider some data to understand the impact of hedging. According to research by the CFA Institute, portfolios that employ hedging strategies, particularly during market downturns, tend to outperform those that do not. For instance, during the 2008 financial crisis, hedged portfolios had losses limited to 15%, compared to an average 38% loss in unhedged portfolios. Why is it important to hedge your investments? Consider the volatility in markets due to unexpected events, economic changes, or geopolitical factors. Hedging provides a safety net that helps secure your portfolio against adverse movements, ensuring you are not disproportionately affected by unexpected downturns. Moving on to some frequently asked questions. One common question is, can hedging eliminate all investment risks? The answer is no. Hedging is a way to manage risk, not eliminate it. While it can greatly reduce potential losses, it's important to remember that it usually comes with costs, such as premiums for options or potential missed gains. Another question we often hear is hedging suitable for all types of investors? Hedging can benefit many investors, especially those with significant exposure to market risks. However, it may not be suitable for everyone due to its complexity and costs. It's generally recommended for more sophisticated investors or those who seek professional advice. As we approach the end of this tutorial, remember, the goal of hedging is not to make a profit but to protect against potential losses. It's crucial to carefully evaluate your portfolio and risk tolerance to determine the most appropriate hedging strategy for your needs. Thank you for joining us in this comprehensive guide to hedging. We hope you found the information valuable and informative. If you have any further questions or need personalized advice, feel free to reach out to us. Don't forget to subscribe and hit the notification bell for more finance tutorials. Until next time, happy investing!